buy or sell commodity options. This is based upon the education of Richard D. Wyckoff. So last week, as you know, we had a very interesting week, and we continue an interesting week. Did you know that December tends to have an up bias to the markets? Usually what you see in December is stock rotation, some of the idle cash going to work, which tends to lead the markets to somewhat of an upward bias. This is different. And what you're seeing in the market over the last several weeks is simply the fact that the market is going through a transition period of very much market uncertainty. And what I mean by that is that markets like the known. It may be a bad unknown, but the markets like to know what's going on. In this case, we have a lot of unknown to the markets for various different reasons, okay? And the markets don't like that. You have the China tariffs, you have the Russian thing, you have a multitude of things that are affecting the market all at the same time. And this allows the market not to have a feeling of stability. And when people get scared or people don't like what's happening in the markets, people tend to withdraw from the markets. And they go into cash, or they go into avenues like the bond market, which is guaranteed. So interest rates by the government. The bonds have never defaulted in the U.S. So people that buy bonds from U.S. Treasuries happen to have a safe yield of that. Okay, it's always the first time, but we will see. But so be it. So far, that's the case. So let's go over the stock market as is, and let's go over what is actually happening in the market. I'll be sending out the weekly charts probably in the morning, like I've been. And the reason why I send out the newsletter in the morning is because I like to get the overnight information to the market. This way, it allows the overnight with Europe, Asia to trade, and we could see what happens. If I put a market that looks like a bearish undertone, week close, the market goes lower and then goes higher, what happens? Well, the analysis doesn't make a lot of sense at the end, right? So what's important to realize is that when I get the most current data, what happens? So that's one of the reasons why that occurs the way it occurs, okay? So let's look at the weekly chart real briefly and see where the market's at. You can see that last week we had a market, the high end closed, it went higher and broke, and the market closed. This is 2603 area. As we see, the market had an up close, a down close. When you see markets that alternate closes, that's a battle between bulls and bears. Obviously, market gets low enough, the bulls, and the market's high enough where the bears will sell the markets. And this is what you have in the market when there's uncertainty in the market, or a market that's going through a particular trading range. The realities get sold and the breaks get bought. So this is what you exactly see to the market, and which is why a strong close in 1 week doesn't necessarily mean the follow-through strength and weakness in the second week. Okay. So I want to spend a week and send out the newsletter. So let's talk about the week that was in the stock market. Well, what we see is the market on Monday. If you recall, we had the gap higher Monday from the G20 meeting. And I had written in the newsletter that the market went up in the market with an increase in volume, and the market closed mid-range. We marked the mark across from here, a perfect retest, and I mentioned in the newsletter that this was not necessarily a bullish bar. Does anybody know why it's not necessarily a bullish bar? The answer is the market itself did not have demand volume in the market. This lack of demand in the market did not have the buying overcome the selling. And the reason why that's important is because you are selling in the background of the market. You're selling in the background in the market. So we needed demand to overcome that selling in the market. The volume was not high enough to be considered demand volume. Very, very important. Because without that demand volume, the market could not get above it. And the reason why that's problematic is because demand has to overcome supply at the creek area. Did not do it. That was a problematic. So the close, that was weak relative to where the market had it. If it was going to go through the absorption phase, it would happen, but didn't. And next bar Tuesday, the market broke hard. What can we say about that market? Well, what we could say is that the market had supply still coming to the market. Having said that, the market now closed on the lows, a bearish close, and the market now happened to go lower. This was Wednesday when we had the markets were closed because of President Bush's funeral. So disregard this day. The week close led to some type of buying to the market, and that closes there. This would, if the market was going under the accumulation, this maybe would be stopping action to the downside, some type of spring. But what happened? The market did not have follow through the next day. The market did not have follow through the next day. The weakness of the day, Friday of today. So this is why background is very important for the composite operator, because it dictates a lot of the market behavior to the market. Not necessarily for our bar-by-bar action that we have, but to suffice it to say, the background has been somewhat bearish overall. The inability of the market to show demand over supply. The inability of the market to have supply coming in on the pullbacks makes a bearish background. Now, let's look at the action from Friday, and we'll see something interesting in the market. You will see the market has, we're looking for some type of ending action in the market. Well, you see the ending action when the market goes above this previous high, above this previous high, forms an up thrust. And the break. This market attempts to have a spring, a market. But what do we know about springs that happen in weakness of markets? They fail. Cannot get above this resistance, and also has an up thrust of this just right here. We had talked about this in the day session during the day. I don't know if maybe people know this, but we have a live chat during the same public room at around 7 o'clock every morning in Chicago. I don't have as much, I don't lecture as much during it because I'm watching markets for clients, but the room is open and we talk about markets in general. So this market now has a situation in which the market has broken and shown weakness. If we go back and look at the weekly chart, for example, or the daily chart for that example, we can clearly see that that 2603 area shows up in a couple of different time frames, which is important. It shows up obviously in this weekly that I mentioned earlier. It shows up also in the daily chart as a retest of the October 29th lows. If I'm not mistaken, in the back of my mind, October 29th was a crash day. I could be wrong, maybe not. And it shows up on the monthly basis. So when you have a situation in which you have a bar that shows up, or a support and resistance that shows up in all, A, you got to believe that everybody in the world knows it, and B, it's somewhat where the stops and the market behavior is. So we happen to know that that area on all three time frames is important. When you have that, you have probably sell stops under the market, and you'll see what type of volume generates if we do happen to get to that level. So, very important aspect of the market. Let's talk about the euro currency. Why? Because in the euro currency, we really don't have a lot that is happening in the euro currency. So that tells us a lot as far as the market is concerned. Why? Because when you have a market, or we have a market, that does not show anything occurring, or a market being very clustered sideways, it tells us something very important. It's not so much of a bar-by-bar exercise I want to talk about for a second, but what I want to talk about is the fact that with everything going on in the world, as far as the stock market being weak, or the stock market selling off, what is actually happening to the market? What's happening to the market is that the euro is now, it moved up a little bit today, okay, but the euro has more or less stayed in some type of clustered area to the markets. The reason why we stay in the clustered area is because the market obviously is looking for some type of news or some type of event that will move the market outside of that trading range, or outside of the clustered area closes. So obviously the stock market influence is not affecting the euro currency. That is important because they're focusing on something else. It may think that it's a U.S. problem, or relative to the U.S. dollar, the euro is also weak, or the economy weak in Europe, and the U.S. is weak, so there's no edge to the market. Very important. So sometimes a market that does not react to something, the market does not react to something, shows something that is very, very, very important. So markets that don't react, ultimately, the euro will react to something. What is it? You have no idea. But there could be something that the market gets affected by, which is something that is extremely, extremely important. So keep that in mind when you look at a market, that all these markets are moving and some markets don't. Talk about metals, because they're important and they happen to be at a preface of something that could be happening. So one of the reasons why I like to do these live webinars, talk about current market, is because it's important that when we look at the action and the behavior of markets, I go back and cherry pick something from 5 years ago, but we have to try to make a effort in trying to determine what the market's doing now. So this will allow us, in the future-wise, obviously, to say, hey, this week, what's going on? Well, what's important that's going on is the fact that we want to prepare for this week. So I can go that I would get this for the recording of the market, the recording, actually the recording, the reaction of the market live for the week. So I want to record that so we have it and look back and say, you know what, this is what's happening to the market. So in gold, we have these little up thrusts, or little probing of the upside. This is very critical in the market because it allows, with demand in the background, these are probes to go higher with demand in the background. Though we were referring to this several weeks ago, maybe in October, and someone from day class had mentioned this as well, and I mentioned that these up thrusts, that the market wasn't really ready to go up yet. It was on this demand bar here. And I said we're probably going to consolidate. These were probes to go higher. We went lower. We retested perfectly to the demand bar. It's very important to stop in this area here. The market has moved up from here. So the market now is at a critical area. It's just in the creek area. Either we up thrust or begin to mark up or consolidate to the market. if you're with me during the day class or you received the newsletter, I've also mentioned that gold is stronger than silver. And stronger, and if you look at the silver has not gotten above that resistance. And there's a reason for it, in my opinion. Gold is more of a crisis metal. And people flock to gold if they feel there's an issue with gold. With the economy of things. Not an issue with gold, but the economy. As far as around the world problems, the economy, as far as not the economy itself, but just unsteadiness, uneasiness to the markets, which is what you're seeing. Silver is an industrial metal that gets used. So silver tends to do well when the economy is doing well. Other factors besides that, gold tends to do well when there's uncertainty in the world. Thus, you see gold being outperformed. And it's been like this for a while. I'm going to caution you. I know it's not outside what we do. It's outside a little bit what we do, but don't necessarily expect silver to catch up to gold because gold's leaving. Markets are strong for a reason and weak for a reason. We talk about that in the member room a lot, but it's really important that you understand that aspect of the market. Crude. So I'm really going over a lot of dynamic markets tonight, because I think these are markets that are really prevalent to the action. So, as you know, or many of you may know or not know, you know from me, but maybe you've also heard it, crude had a stretch of 12 straight days to the downside. It's never had that before. You could have 50 days, who knows, but this took a day at 12. So something interesting happened with crude oil. Crude went down. Now let's just take the action of the market. Still selling present. Then you got a bit of sideways action. And nothing really is bullish about that, is it? You don't have any demand. You don't have any extension to the upside. You don't have anything that you could consider bullish to the market. So the market tries to go higher. And then we have the market, this area here, the largest volume in the area. We mark that going across. And then we see the market to the downside. We see low end closes. The first low end close, increasing volume, selling. But the second one has light volume. Does it make a difference? It doesn't. The difference would be if the market has demand to the upside. The fact that the market had low-end closes without buying in the background tells us that the market most likely will go lower. So we never ever say F's always 100% in trading. We always could be a situation where the best looking chart could be dead wrong. A market that looks bearish or not good for position may end up doing well. So markets are extremely, extremely uncertain, and the risk of them is great. And especially when a market's either marking up or marking down versus a trading range. So you have a tremendous amount of risk in markets today. And I think that it's a very difficult trading environment. More so than normal. But never, I always say people hope for the best and expect the worst, because markets will always be surprising you. And most of us probably get surprised to the wrong side of things, but really there's just tremendous amount of risk in it. With obviously the market moving, people see the potential of making money, but you got to see the potential of losing money, relatively speaking, to that. Okay, so the market's down here, tries to find demand, increasing volume, does a pretty decent job as far as that's concerned. As far as the market, the close could have been up red, but because it's decent enough. The key would be if the market then has to a point where the market then would go higher. The next day on the 7th, Friday, high volume, mid-range close. Probably more negative than bullish, than bearish. More negative than more bearish than bullish, because the market's inability to rally. Then you can say, well, again, is the inability of the market to break is bullish. Well, in the case of a negative background, you have to be extremely careful with that analysis to the market. Okay. So that's crude. Crude is extremely important because what crude does is really an economic indicator. When companies can raise prices and crude oil is higher, they can mark up prices more. When crude oil is cheap, it's seen as recessionary. Companies cannot raise prices in that type of environment. Which is why many times, I think crude oil is one of the most, I think you've heard me say it before here, but crude oil to me is one of the most manipulative markets there is because of the international game that gets played with that. So when crude goes lower, it's seen as more recessionary or slow in the economy. Usually people don't want to be paying, obviously, money, for, increase money for gas, but if they do it, it means that people are able to afford it and they can actually raise prices. So that is something that we have to keep in mind as crude oil trades, with that in mind of crude being a political game, Saudi Arabia, U.S., and those things, a political game that goes on. So, to me, it's a very highly manipulative market in the crude oil. Let's talk about the bond market. And we talk about the flight to quality and safety. And the bonds kind of showed the behavior of the market, of the stock market breaking by the daily chart. So this is the Fed can influence it by adding money, subtracting money from it, but they can't raise interest rates or lower interest in this particular market. So bonds are kind of unusual low or market behavior. So we see a market that has been going down. We have a couple of high-end closes, short covering, and we want to mark our bond trade here. We want to mark the market also from this low here. Both of those gives us an area of the market having support. As the market then begins to rally, the shorts cover. And the market we know has some type of secondary test to the market. Secondary test to the market. We like to see what this is. The market comes back down and we see a high volume or higher volume and a cluster close to the market. The next bar comes, smaller range bar, half the volume, close of the lows. That's not really such a situation where the market is bullish, obviously not bullish, and still bearish until we get some type of demand in the markets. One of the people mistakes they make is when they see a sideways market after a prolonged down, they think it's accumulation. Not true. You need some action for demand to overcome that supply that's selling. So, we have this reactionary high here, and we have this reactionary high as well as here. So we look at both of those things as being somewhat of an area that the market could retest, and with demand will have to overcome supply, or buying will have to come selling to that point. The market then goes higher, all short covering. Disregard this volume because it's roll volume from the December contract and the March contract. What is important is that the fact of the market, these bars, even though they're sloppy, the bars were able to maintain near the area of selling. So sell. But the market was able to not get supply in that area. The market was not able to get supply in that area. And the market inherently absorbed that buying and marked up. There's a very interesting study in the weekly chart that I sent to everybody. The newsletter wise. You can see right here. So I'm talking about the retest on absorption. Let me talk about this bar action here. As the market had this selling here, you actually see them more better than weekly. Look at the closes. Ability of high-end closes allows the market last week to mark up. We are still in an area that's critical because we have to take out the year high. Probably comes all the way back. We're here. 16, February 18. Well, let's get back. Well, I'm sorry. This is different here. No, maybe not. Wait. Here's the week's high. So you can see that the bond market did not necessarily have demand from the bottom as high-end closes did have the short cover into the market. So we shall see, a market that is most bearish in general, will lag behind the market's weakness overall. Something that's extremely important. Strength begets strength, weakness begets weakness most times in markets. There are always exceptions, and nothing's, again, it's not 100%, but markets tend to stay weak for a reason and tend to stay strong for a reason based upon the CM's intention of the campaign that they run with the particular market. When a campaign is run, by the composite operator, it's not run necessarily for several hours in the market. It's run over a period of weeks, months, or possibly even years. So this is why many times when people look at a market, they may look at intraday weakness and think that the market is weak. In effect, the market is actually coming from strength of the market and not necessarily weakness that 1 day or 2 days may perceive the market. Markets that have a correction or go downside in an overall bullish market allows the composite operator to buy the market at cheaper levels. They use that as buying opportunity. If a stock is at 50 and then the stock goes to 30 based upon a couple of reports, and the composite operator feels the market's going to be worth $80, he'll accumulate more shares down at lower levels. It's extremely important. This is why the composite many times will protect the integrity of the trading range. Because he does not want to facilitate more selling to take out a larger long position, or vice versa. So we don't always get that particular the action in which the CM will try to fight off the funds and specs, but discussion. One of the things that benefits from weakness is the yen. Let's look at the behavior of the yen. And as I mentioned to you, we like to do these things in hindsight to the market. You see the yen having these buying tails on the weekly basis. These last several weeks have been retests of see that the yen would have to overcome the area right here at 90.15 area. That's important because the Japanese do not like a higher yen in terms of exports. We shall see. Last week in the day chat room, we talked. Somebody mentioned about the British pound having some type of spring retest, and even though at the time I looked at it, I didn't know something interesting about the price action and the bar reaction of the market. If you see right here, you see the market has a shortening of the downward thrust. The volume's unequal, but the market, if you compare the ranges and the volume, those that work with me and get the newsletter and the mentoring, you see the volume very similar. Yet the ranges are much smaller, but the volume is very similar. Indicates effort versus result in the market. This led to the short covering rally until we saw the area of selling. So the market went up short covered, a little spring, a little short covering. This area is important because this area right there, that bar there, has this high volume action. Perfect retest, selling. I was going to make a comment that bar, but I'm not. Nondescript bar, selling, boom, boom. So now we see another situation, and we have increasing volume, smaller range. That could be a market. There's retesting on a smaller range effort. What would be needed, now we have the cause that's built for the last 3 months. What would be needed for the market here? We need some type of strength on the right-hand side of the market of buying that may occur to the market. That's what the market would need. So in this case, if it does not run away from price, this is an area of distribution to the market. So the short end of the thrust was nice, but the market's inability to rally above resistance is troublesome for bulls. The market then retested it. This is definitely average result bar, cluster close, but the market needs demand. So I mentioned earlier, about 15 minutes ago, just because a market goes sideways after being bearish doesn't necessarily mean the market becomes bullish. And we need that demand to come into the market. To become bullish. So we need to run away from here or mark down. Why did I bring this chart up? Because of the cause built in the market. Because of the cause. Is supply needed? No, because the background is negative. So the market can fall its own weight. Is demand needed? The answer is yes, because the supply that's coming off the retest. Let's see right here. It's very important to note the background and the trading range, subsequent trading range after the market. It tells us a story, the inability of the market to move potentially higher without that demand. That is extremely, extremely important. What we need to know is importance of the background. That background will tell us many times what that trading range becomes. Not always, but not always, but what's really, really important is to understand background, because the subsequent action that happens after the background and then the trading range generally goes in the trend of what the background was until we see some ending action. In this case, we have selling in the background. The bar action dictates the possibility of shorting of the downward thrust, but because of the selling that occurs in the market, the market needs demand to overcome that supply. So an extremely important aspect of the market in trading is extremely important that we understand the bar action. Somebody, mentoring student, asked me about if I could talk about reading the tape in Wyckoff. And I mentioned to, because he heard that other people were talking about reading the tape, and he referred people to our site and to us, even though he's a mentoring student from Australia. And I said, well, what you learn when you're mentoring it for me is how to read the tape. When I go over bar action, bar by bar action with you, it's reading the tape. Effort versus result is reading the tape. Effort versus result is reading the tape. And that is important. In other words, if I see a market that has effort versus result, that is reading the tape. It's the amount of shares that are put upon the market itself that's either accepted or rejected. If a market gets bought near support and there's a wide range of upside with volume, then the market's not accepting lower prices and it's moving higher. If a market does not react from support, the market's now accepting the prices at that level. So we can see that with price action. If we stay down here, the market's accepting lower prices. If we run away from here, the market's not accepting those prices, running up to find higher ground. So that is reading the tape of the amount of shares and the bar reaction that occurs. That's what they used to do, back in the Livermore days, where the guy would say they buy 100,000 shares of Anaconda, right, or 100,000 shares of Blue Star from the movie, right? Well, it's how the market accepts the amount of shares that occur in the market. Something that we need to understand the market. Now, when we go back and look at the S&P, and I want to end our conversation with that today, or with this type of action. We know that when a market bar action occurs at the same pricing on the time frames, monthly, daily, weekly, we know that that market tends to be important. That aspect of the market is important because that's where the stocks build up. Markets are about who is making money and who is losing money. So if you're in a situation, I'm just going to take the weekly chart, and you bought the market anywhere on this rally, anywhere in this market, all those shares that you bought, it's now bearish, and if they get under here, most likely people would get out of the particular stock because the market made new lows. If the composite operator is looking for markup, so to speak, the market has to have some ending action down here. Something that's really important. Okay. So when I talk about markets that's about money, if you start to see a market making new lows and it shows up on all three time frames, the sell stops get triggered on the monthly, the weekly, and the daily basis. It's a very powerful statement when a market takes out a monthly support and resistance. Daily is important, weekly is important, but obviously the longer the time frame, the more of the background that you know the trend of the market that you may have. So I'm done with the conversation tonight as far as that's concerned. As I mentioned earlier, because something new to me, so I'm almost excited-wise, but we're going to post the things on, so I'm getting more into people with social media. I'm putting up a couple times a week in YouTube. I'm also running for some of this bar charts, I think, Inside Futures, that they've asked me to do some Wyckoff there as well. And there's a lot of interesting stuff that's been going on with this, our educational / contest that's going on as well, too. So it's kind of something that's unique, something different. You can read about the details of that as far as that's concerned. Okay? So people have asked me during the conversation today, the email, this is my email directly to me. So feel free to contact me anytime. But more importantly, if you want to Skype me, I'll just give you this for you, okay? Very important that you use cautious market. Usually December does not allow this type of volatility. This is an exceptional time. We have different types of people that are running the government as far as market volatility is concerned. And markets tend to get the situation where we get uncertainty to the market. So be very careful. We talk about a market that's below the trading range. And we have to see what's important area-wise. Now, obviously, I can't leave without saying this to you guys. This February low, obviously the low of the year as well, too, right? If the market takes out that low, that's where you're going to trigger all these sell stops, I think. And then there's going to be a big battle going on. Transfer risk. Or maybe the longs that decide it's time to bail. The new short's getting in. Let's see him make a decision of what he wants to do. So major areas have major stop-loss areas generally. Not always, but generally. Because they accumulate as the market's going higher. They tend to, some people trail their stops and use a previous major low as a stop-loss area. So this market is coming from weakness. We described what this is already. We described what this is already. You have to determine what that definitely is. If you was to look at today and say, this is the action I'm showing with, does this paint a pretty picture? The answer would be no. But here's the caveat to that. You have a market that's still in a bull market, still above February lows. Since the monthly chart or the longer term charts are up trend, a market lower time frame will turn more bearish before the longer term will, right? In other words, the daily chart will turn more bearish than the weekly chart because the daily chart can be worked week on Monday, Tuesday, Wednesday, but the weekly chart doesn't get painted till Friday. So as the daily may be breaking support, even the weekly is breaking support too, you have to look at the weekly close depending on the market bounces or not. Well, the daily chart time frame is smaller than the weekly chart, so that's important.